You're live. Have a good show.
Good morning, everyone. Here we are, Monday morning. We had some missiles flying over the weekend, but nothing dramatic yet. We're talking about oil prices and what's happening in Iran here. Charlie's going to talk about some of the financials and banks here after I kind of touch a little bit on what's going on in the energy world today. And oil prices are still up here. WTI still hanging up around $112 a barrel. What is interesting is that looking out at the strip 12 months from now, we're still hanging in around $72, $73 a barrel. So the market still believes at some point there will be some resolution, some resumption of the shipment of crude through the Strait of Hormuz, and that it still prices in that 12 months from now, we're going to be at $72, $75 a barrel, which has been the case all along. It's the front end of the curve or the spot price that continues to be quite volatile on whatever the latest headlines or fears are in Iran. And we're sitting here looking at a looming deadline supposedly tonight as to if there's no deal. The latest is if there's no deal, Trump is threatened to go in and start bombing bridges and power plants, which apparently he already struck their largest bridge here in the last 24 hours. At the same time, there are headlines that there may be a 45-day ceasefire or truce here to sort of iron things out. We'll see what happens, but um, oil is sort of reflecting near term, at least, that there's going to continue to be conflict, that there's no quick reopening of the Strait of Hormuz, which clearly is the case today. The fear is that this is not going to be an easy solution. And we've talked all along about the fact that this is sort of it is a religious war for Iran and for the leaders there that are calling the shot still. There's been no regime change. And the leadership, whoever it is, seems to be pretty entrenched and talking the talk and continuing to fire missiles. And doesn't seem to be any de-escalation in what Iran is able to sort of do in targeting Israel, continuing to target their neighbors, and continuing to have some missiles or drones that they're using to fight back. And so it we'll see sort of how this plays out. But certainly, the longer it goes without any regime change, with Iran continuing to fire missiles and fight back, the more uncertainty there is as to what is the final outcome or solution here, and particularly with no regime change, which means that they're talking about some sort of backdoor talks with Pakistan being an intermediary, trying to come to some sort of agreement, but we don't know who exactly that's with. They claim that maybe it's moderates, but I don't know if moderates truly exist in this the regime that's been in power here and seems to be still calling the shots in a regime that all along their objective has always been for more than 20 years to have a nuclear weapon and to basically create chaos in the Middle East. So, um, this is still a can of worms that doesn't seem to have any lid that can be put on it anytime soon. And in the meantime, oil prices are going to hang up here. Now, the stocks themselves, if we look at the energy stocks, they seem to reflect a little bit of exhaustion in the sense that, you know, they aren't running up on this oil price being $112 a barrel. And if I look down, they're all off, pretty much all the E&Ps and certainly the integrateds are off their highs over the past several weeks. So the market seems to be anticipating that maybe oil prices have peaked for the moment and continue to price in or value these stocks in what is the longer term 12-month strip. So we'll see how that plays out. But in the meantime, all these companies are minting cash on what they're receiving for the price of oil today. And, longer term, or at least near term, part of the issue is really, as we talked about last week on the refining capacity, we've seen product prices, gasoline and diesel, run up more than what have crude oil prices, just given some of the refinery outages and damages in the Middle East. The other side of the equation is natural gas. That gas, and we talked about this last week. In the U.S., natural gas prices are sort of reflecting what are the dynamics here in the U.S. and North America, apart from what's happening in the Middle East and the rest of the world. And that natural gas in near-term spots at around 285, which is what you would expect here in the shoulder period without a lot of heating or cooling load demand, with storage levels in good shape coming out of the winter and looking ahead toward the summer. So if there's anything that I'm sort of keeping an eye on here, the energy stocks, the oil stocks seem to maybe reflecting a little bit of exhaustion here on this run up, are some of the gas names and seeing if they pull back any further. Names like Expand and EQT and Terrell Range, some of those names, if they were to pull back even further here on this relative weakness in natural gas prices, I say relative to oil, um, that may be the first place that becomes more interesting if you were to add to positions. In the meantime, on the oil lever names, still just holding tight here. Not buying anything, not selling anything, not writing any covered calls on the oil price here. I think all along I've been saying at a lower price, I'd take the over versus the under. At this point, I think it's sort of even. Um, I don't think that today, given everything, I'm would take the over versus the under on $112 a barrel, maybe slightly bit on the under that there is some sort of resolution or some
Uh, I'm going to take
agreement
the over. I'm going to take
of,
the over.
yeah,
I'm
I've
going.
been,
I'm betting on 150 to $200 barrel.
I mean, that would wreck the entire market. So,
Yeah, it would.
it's
It
hard to
really.
call. Nobody knows.
That's
You
true.
know, the one outcome is that if there's no agreement and Trump goes in, starts blasting bridges and power plants and everything, Iran's not exporting any oil, and it's going to make it even tougher in any recovery if there ever is one for the country.
Yeah,
Um, so
Bob.
it's just a
Sorry. Go ahead.
no. It's just nobody can predict what the outcome is going to be here near term, but it's still very. It's not. It doesn't look promising or optimistic in the sense of peace breaking out. I mean, the best case scenario is that there's a 45-day truce to try and iron out some sort of agreement, and we'll see what happens. Again, you're dealing with a regime in Iran, or the U.S. is dealing with a regime in Iran that has never been transparent or honest in what they're willing to do, basically. And I don't see any evidence that we're dealing with a truly different regime than what's been in power, what's been in place here. We don't know who Trump is negotiating with, but it doesn't, given what's going on there, it doesn't seem to be certainly not a regime change or a new regime here that you might be able to trust more so than what's been in place the last 20 plus years.
Bob, I mean, you touched on this a little in the beginning, but oil is in backwardation. We're 111, 112, whatever it is, front month, and it goes down to 75 by December, or even 70 by December.
Mm-hmm.
Um, so obviously, the market is saying we think this is just a short-term problem. But I've also heard that we are, what, 3 million barrels per day in deficit. Does that sound possible? And we've never been there before, maybe in the 70s, but probably not. Um, and then, to bring stuff, around the world via tankers is probably 2 or 3 months time, given the delays. Do you think this stays in backwardation and or
In near term, yes. I mean, there is a lot of oil on the water, and the thing is, the deficit arises when you shut in wells. That when you bring those wells back on, you don't bring them back on at a higher rate. So there is some oil in what would have otherwise been an oversupplied market this year that we're not getting back any, until basically the end of the life of the well. I mean, you just postpone the end of the life of that well when you stop the production and turn that well back on. But there aren't a huge number of wells that have been shut in per se. And in the meantime, to try and ease the supply demand tightness, sanctions on Russia have been lifted. The U.S. is trying to get Venezuela back up. Oh, that's going to be a very slow track. And so, if everything were settled and the Strait of Hormuz were open and all facilities were able to begin to be repaired and brought back online, I don't think we're in 3 million barrel per day deficit in that, if you're looking at 3 months from now. Maybe 1 to 2, maybe not much at all. Again, the bottleneck's going to be on getting this refining capacity in the Middle East back online to then refine the crude oil into the products that is really what we consume. So there's not, production wise, there's not a lot that's been, if any, that's been destroyed per se. It's just the infrastructure around that infrastructure to refine that crude oil that's been damaged that needs to be brought back online or put back in place. So again, if we had a truce tomorrow, the Strait of Hormuz were open, everything was able to operate as normal at least for 45 days, I don't think we're at a big deficit. But again, it's on the refining side that is a critical bottleneck now, given some of that damage that's occurred. So,
And the
you know, you
crack
don't
spread,
read you
the
don't read any
crack spread
headlines
for
about.
the refiners are pretty attractive too. So, but you haven't really mentioned the refiners like the Valeros at all.
I mean, we bought a little position. I'm still underweight Valero, and you know, several months ago began building a position, then stopped once it ran up above 200, and so I'm just holding that position right now. Valero is the one name that I own on the refining side, but it's again the market's reflecting that if there is some deal one way or the other, longer term things come back down into balance, which is why you look out December, January, right around $72 a barrel. But near
Mhm.
term, it's going to take a while. Even if there's a 45-day truce tomorrow, it's going to take a while for all this to come about to get everything put back in place and operating as it was before this war broke out.
And natural gas is less affected by the straits being closed, and that's why it's been weaker. And
Well, it's be
in
weaker in the U.S. Europe wise, it's up because
right,
those LNG tankers from Qatar that aren't running now, or those LNG facilities in Qatar that have been damaged and may take a long time to repair, those go to Europe predominantly. And here in the US, we're sort of maxed out on the export capacity that's up and operating. There's more coming online, but we're sort of maxed out on what LNG exports can occur today. So it's not like we could ramp those up sharply to make up for what's not flowing out of Qatar today. And we are in the shoulder season here. So basically, the supply demand dynamics in the US aren't really impacted by what's going on in Qatar and the Middle East just because we're not able to ramp up LNG exports to ship over there. So we're still sort of confined to what the supply demand dynamics are here in the US during this shoulder period. And that's why US prices are sort of punk in the sense of where you would expect them to be now, irrespective of what's going on in the Middle East. But in Europe, yes, natural gas prices are way up.
and if you were to speculate, fundamentally, what do you think the catalyst could be to get natural gas attractive again? I mean, you mentioned EXE, which I own, and EQT, which I own. Thank you to you. But EXE is kind of languished here, what 100 to
Mhm.
110, something in that range. What would be the
Yep.
catalyst to get those things moving again?
We just need to see firming up in natural gas prices this summer. I mean, we're coming out of the winter with storage levels that are close to where they were. I think a little bit above what they were a year ago, and so now it's a matter of what the weather is in the summer, what demand is, and how quickly those storage levels can be refilled. And with a normal summer, we'll get storage refilled going into next winter, and then it becomes a question of winter weather next year. In the meantime, what everybody's pointed to is the startup of some of these LNG export facilities that'll start to come online. There's several over the next several years, and demand from these AI data centers. When I look at nat gas, next going into the winter past the fall shoulder period, we're looking at October, November, December, 330, then up to 440, 490 in January. And so that's really, you're sort of hung out on weather right now. Unfortunately, we made it through the winter without storage levels being clobbered. We're now in the shoulder period where there's not a lot of heating or cooling load demand. And now we're looking with a normal summer on pace to sort of get storage refilled going into next winter. So in the meantime, you're looking at what demand pickup there can be from these new LNG export facilities, demand from AI data centers, and then sort of where we are heading into next winter. So what is the catalyst to get it up near term? A hot summer.
Which is very possible given, at least in the middle part of the country, given the dry winter we had. I mean, they're
Oh
worried
yeah.
about in Colorado and California, they're worried about wildfires because of it had no snow basically.
Yeah, in Colorado they're worried about water rationing this summer.
Yeah, yeah. So it could be a very hot summer. based on how the winter played out. Um,
Yeah.
yeah, interesting.
So we'll see. That's sort of, again, it's every morning you're looking at if there's any tweets from Trump and sort of what the latest headlines are, and it's just it's hard, impossible to predict what happens from day to day here, and so we'll see.
Yeah, the tweets are getting scarier. Um,
I guess in the meantime, what are you looking at on the financials and such here? I know you've
Well,
been seeing.
as you may know, financials are the first out of the gates to report first quarter earnings. So starting on Monday, we get the first of a number of the large banks reporting with Goldman Sachs. Um, Earnings season in the first quarter for the banks should be very, very robust. But the question is, how sustainable is it? But let's just look at some of the expectations for the first quarter. On average, the large cap banks, which I follow closely, I'm
Mhm.
expecting earnings per share to be up about 20% year over year. So it's a pretty robust first quarter. Just to put that in perspective, the S&P earnings are going to be up about 13%, and then all financials, which includes insurance, fintechs, et cetera, should be up about 15%. So the large cap banks, led by the JP Morgans, Goldman Sachs, et cetera, are going to be very strong. And the regional banks also will be very strong. In fact, the banks are, the financials, I should say, are going to be the third best performing sector within the 11 S&P sectors. So they're going to set a pretty good tone. Now, the question is how much of that has been discounted,
Right.
and how sustainable is that? And so I don't know, Jen, sorry, if you could put up the first slide. So these are the earnings expectations. The one thing I would point out is, the my expectations versus the street. So my expectations are on the left-hand column. The street consensus expectations are in the next column. And generally speaking, I'm a little bit higher than the street. So I'm expecting positive earnings expectations, which could lead to revisions higher for full year 2026 earnings. Um, the Where I would differ, if that's what happens as earnings come out, if there are positive revisions, I think this is going to be the best quarter of the year. So I think it's a sell on the news type of quarter. Um, the big thing is going to be, what the revenue outlook is. So Jen, if you can go to the next, um, this is the revenue expectations. In the middle is sort of I don't know if you can read it, it's kind of fuzzy to me, but maybe that's my eyesight. Um, are the first quarter, in the middle column are the first quarter revenue expectations. The left-hand column is the 2026 full year expectations. And one of the things you'll see if you can read this chart is that the first quarter revenue expectations are going to be up 8, maybe 9%, depending on who you're on average. And then the full year is going to be, up 6 or 7%. So there's an expected slowdown built into some of the revenue expectations as the year progresses. So I think the first quarter is really going to be the best quarter of the year. If you go to the next slide, I'll tell you why I think the first quarter. It's capital markets. Capital markets are going to be very, very robust. And by capital markets revenues, I mean trading revenues, which is going to be a record quarter. By the way, capital markets is going to be a record quarter as well for total capital markets. And it's going to be led by trading, which is going to be a record quarter. So for this group of 5 banks, I'm looking at 50 billion plus of total capital markets revenues. That's trading and in investment banking. But of that 50 billion, trading is going to be about 40 billion. Both those numbers are record all-time highs. Investment banking, which is the other, 10 plus billion, is going to be a strong quarter, but not a record quarter. You have to go back to the COVID days of 2021 when you were getting about 13 billion a quarter. So going forward, what I'm expecting is that the trading part of capital markets is going to start to weaken. So you had seasonally, usually the first quarter is the best quarter, but going forward, trading starts to trail off. But investment banking probably will get stronger, led by M&A and equity. The problem is, given the size of trading revenues, If you get a 10% drop off in trading revenues, you need a 35 to 40% increase in investment banking revenues just to stay even. So it's going to be hard for these capital markets companies, if I'm right about trading, weakening going forward, to sustain the kind of earnings levels that they're going to produce in the first quarter. So let's finish up, and then I'll stop there with this last slide. These are the basic trends that you're expecting or at least I'm expecting for the first quarter. If you go all the way over to the right-hand column, you look at the year-over-year trends. So total revenue is up 7.7%, or roughly 8%. And that's going to be a function of net interest income or spread income up 7%. That's what drives regional banks more than money centers, versus fee income being up, 8.7% or 9% on average. And that's largely driven by the capital markets, trading, and investment banking, which is what drives the money centers and investment banks. So revenues are going to be pretty robust, I think. The other thing to look at is expenses. They're going to be up 4.8% on average, a little more than inflation. But with 8% revenue growth and 5% expense growth, you're getting 300 basis points of positive operating leverage. So that's really good. And then as you go down that last column to what we call PPNR, that's pre-tax, pre-provision net revenues, that's going to be up double digits, 12%. So that's before any credit problems, and that's really very robust growth. And then on the credit front, I'm not expecting much in the way of negative surprises. The consumer is still in fairly good shape. The corporate side, in banking, I'm excluding private credit here because there are problems in private credit, but in banking, where they've been much more conservative, the problems really haven't arisen yet. We may have one or two names that arise that could affect negatively, let's say a Wells Fargo. There's a UK mortgage company called Market Financial Solutions that we know has gotten into trouble in the first quarter. So there may be some spotty problems, but overall credit quality should be fairly benign. And then the last thing I would just mention in terms of taking that PPNR up 12% and turning it into a high teens type of earnings per share growth rate is buybacks, and you're getting buybacks of anywhere from 3 to 7% this quarter. That is going to boost EPS. So it's going to be a very positive quarter in terms of what gets reported. I would say that if you looked at the price performance of the bank stocks in the first quarter, they pretty much have mirrored the first quarter earnings expectations. I think three of the best performing stocks in the first quarter were Citigroup, Citizens Financial, and M&T Bank. And all of those are going to report very strong earnings per share, or the three of the five best performing stocks will have the strongest earnings per share growth that I mentioned. So, I think a lot of this has been discounted. I think we get a fall off in terms of the earnings momentum going into the second quarter. So my guess is if these things trade up into earnings, they're going to trade down coming out of earnings. So I'm not chasing any of these names. I'm kind of like Bob. I'm watching my group and not chasing.
So Charlie, it sounds like the market sort of baked in a good first quarter. You're a little bit above consensus in Q1. So what moves these stocks sounds like is probably going to be the guidance then for the rest of the year, and what comments from Jamie Dimon on the economy and how the rest of the year looks. Are you
Yeah.
below consensus for the rest of the year, or sort of what is the expectation from consensus of the market for the rest of the year that may surprise one way or the other?
Yeah, I am below consensus because I have provisions for, that's what you put aside for potential deteriorating credit quality. I have provisions rising fairly aggressively by the second half of the year. And it's been my expectation is that we could be in a recession by the fourth quarter. So as some of those macro concerns emerge, and you alluded to Jamie Dimon in his annual letter this morning that he released this morning, he says he thinks there's going to be more credit problems out there, and I'm in that same camp. So banks, are not really good plays going into a recession. They're great plays at the at the trough of the recession because they're good early cycle performers. Um, and so I'm, if we got a 30 or 50% correction, and I think we will, over the next year and a half, um, I'd start to, really load up on the banks because I think for the first time in my career, the banking system is going to prove to the world, to the investment community, that they are good managers of credit risk. But no one's going to believe that because they just haven't been over the last 3 or 4 cycles good managers of credit risk. But this time, I think they are going to prove themselves as good managers of credit risk. So I really want to buy them aggressively at the trough of the next downturn. But I think they'll act just the way they've always acted, as underperformers going into the recession.
So, Charlie, we've had this market where every time it seems like things may settle down in the Middle East, the market wants to pop,
Yeah.
and the financials sort of run up with that. So, say this afternoon we learned that there's going to be a 45-day ceasefire. Oil prices come back under $100 a barrel. The market gets optimistic about that, and the banks run up into that. Would you fade them then? Would you be looking on any sort of market rally on expectations that we get some sort of peace or deal in the Middle East? Would you fade that sharp rally in the financials if that occurred?
I would, and you're absolutely right. If we get a peace deal, banks are going to, with the market, are going to skyrocket. But the reason I would is because prior to the, incursion into Iran, the financial conditions were deteriorating. You
Mm-hmm.
were seeing bond spreads widen out, leveraged loans were trading at discounts, rate structures were still, problematic. Um, and you were starting to see one-offs, which usually, in on the credit front, like Tricolor, First Brands, Market Financial Solutions, those all occurred before the Iran incursion. So the signs were there that we were starting to see some deterioration in financial conditions. And I think that will continue, even without the stresses of the Iranian conflict. So, yeah, I would fade them, but there's no question they'll have a really nice pop if you get a ceasefire.
Yeah. So it's going to be an interesting week or two here between headlines out of the Middle East and earnings out of the banks and the financials starting next week. It's hard to predict which way things are going to go. I think the only thing you can say with certainty is there's probably going to be a lot of volatility one way or the other.
Volatility is what you want to buy for sure.
Yep.
Um,
So, well, good. Well, I think that sort of wraps it up for today. Thanks everybody for tuning in to Wall Street Beats, and we'll you can catch us online if you have any questions. And your members send us a message. But we'll be back online tomorrow. Thanks, everyone.
Thank you. Bye bye.
Are we still live, Jen?